On the first day of stock trading for 2020, the stock markets jumped out of the gates reacting to the shot of Chinese stimulus that drove world equity performances. Gold prices climbed to a 3-month peak, while yields on U.S. Treasuries fell on optimism about the world economy. Reportedly, China's central bank was freeing the equivalent of another $115 billion to prop up their slowing economy. Rather than reflecting on 2019, this to me seems to be the continuation of the surge that happened toward the end of 2019. And leave it up to me to pour a contrarian bucket of water on all the good cheer going into the new year. So let's take a look. It is a new year, but please don't jump into 2020 buying stocks with both hands and feet. Not yet. Instead, let's just do a little reflection on the facts as we try and understand where we may go in 2020. First, this is the old fear and greed chart from CNN that we've pondered in the last few weeks of December, and it is up a few points from just say a week or so ago. And as you can see, the current measure of 96 is, I believe, the highest measure on record. Now, I don't know how long CNN has been measuring with this index, but it goes back at least a few years. And as you may observe, the market has never, ever been more complacent. And you may also recognize that the last time we were near this reading, which was in late 2017, the market was traveling down the path to the correction in early 2018. Next up is this chart from Bloomberg showing the S&P 500 price to sales ratio that goes back to about 1990. And this is similar to the price earnings ratio or a PE. The difference is that the price to sales ratio is much more difficult to manipulate than a PE. So this chart actually carries more validity to it. And as you can see, the current level was reached only 2 other times going back to 1990. The first peak was just before the dot-com crash in the year 2000. The second time we reached this peak was again going back to early 2018, just as we were heading to the early 2018 correction and the VIX Mageddon, if you remember. And this chart here, also from Bloomberg, is a variant of the chart you just looked at. And this chart is the S&P 500 enterprise value to EBITDA. And EBITDA is the acronym for earnings before interest, taxes, depreciation, and amortization. Now, you really don't need to know all that, but essentially the important part of this chart here is that the same high valuation points are showing up as the one we just looked at. Now, there's a lot of other charts out there, but we're not going to go through them all. But for fun, we just have this last chart from Bloomberg once again, which shows the S&P 500 compared with US corporate profits. And as the chart shows, the only other time that the S&P was decoupled from corporate earnings by this much was just before the dot-com crash there in the year 2000. And if you notice, the current measure appears to exceed the measure back in the early 2000s. So the problem with this chart, though, as I'm sure many of you perhaps have figured out by now, is that earnings may simply be fake earnings and may be highly suspect. So I'm not sure how much we can really rely on this chart. But these charts pretty much all together confirm one another, and that's really also the more important point. And the lesson is that it may be a new year, but don't get caught up in the euphoria. The stock market may not necessarily crash here, and it simply is providing you the opportunity to recognize the caution flags along the path. So take heed and have a wonderful new year. And for today, that's ChewDog Charts. Thank you.